Okay, so good afternoon, everybody. I hope you are all well. You've all had a good week in the markets and you're looking forward to today's webinar. I'm going to give you some information that I really feel is going to help you with your trading today. As I said, it's how to take big trades that win. Bit of a mouthful there in terms of a title, but really this is a kind of information that very few retail traders look at, but actually it's the kind of thing that is going to help you a lot, I promise you. Now, some of this in the beginning, it may seem a little bit overwhelming, but please just bear with me and stick with me to the end. I promise you by the end of it, you'll look at this and you'll be able to look at the markets in a completely different way. Now, that's not to say that, you're going to change your strategy or anything like that. What I'm going to show you here, you can actually mix in with the current strategy that you've got. So I'm not going to teach you a way of technically getting into the markets or technically getting out of the markets. What I want to focus on is helping you identify market conditions that are conducive for profitable trading. Because that's half the battle. There's a million and one different strategies out there that is going to make you money, right? The problem is that knowing when you should deploy these strategies. And, traders, we make money when the markets move. So it makes sense for us to get into the markets when they're actually moving rather than trying to buy, sell, and the markets are just moving sideways and not doing anything at all. So what I want to do is let me just show you a chart very quickly. All right, just whet your appetite very slightly. So what we're going to be talking about in this webinar here is you see moves like this, right? So ordinarily, if you're trading a technical strategy, let's zoom out a little bit. We can see that the market has come down towards a bottom here. After the fact, we can see that this would have been a good place to buy, right? After the fact, that's the problem. Is when you're just trading technically, it's after the fact. So the market had been selling off quite a lot. But how is it that you identify these sorts of turning points in the markets? And how is it that you can have confidence that the markets are going to rally over the coming weeks? And similarly, if we go back over here, so towards the end of last year and beginning of this year, how is it that we make the decision that actually the dollar yen will probably sell off from this point on here up to when it started to rally? And then conversely, again, if we look at what happened throughout last year, is there a way for us to be able to look at this sort of price action before the event? So after the event, it's easy. After the event, it's easy to look at this and say, I would have been here, I would have bought here, here, and here. Perfect, wonderful. But is there a way to say, well, actually, when we're at this point in time over here, I want to be a buyer. I believe that the market is going to move up. And then at this point in time here, when the market is moving against me, to say, well, no, not a lot has changed. I still want to be a buyer so that you can take advantage of these moves. And what it allows you to do is, instead of being one of those technical traders where you've just got to have your 1% risk or 0.5% risk or whatever, you get certain, conditions in the market where you can say, well, you know what, this is actually something that's worthy of taking a little bit more risk. And maybe I build into a position here rather than just taking one trade. Maybe I hold the trade, and as it goes with me, I add to the position because the market is proving to me that my theory on the overall direction is actually correct. And you end up coming out of a move like this where ordinarily technically trading, maybe you got 3 or 4 entries and maybe you're lucky enough to come out with 4 or 5%, but actually by taking the approach that I'm going to show you on this webinar here, you can come out of this having taken 10, 15, 20%. Okay, you would have been able to make that on your account. So does that sound like a plan? If I could show you how to do something like that, would you all be happy? Just type a yes into the chat box just to let me know that you're all here, you're all alive, and you're all paying attention. And then we will get going with the rest of the webinar. So you all with me? Does that make sense? Happy to proceed? Excellent. Excellent. If you just send to everybody as well, that way we can make sure that it's all interactive so everybody can get the best out of it. And feel free to ask questions throughout. All right, that's the other thing. I can't guarantee that I will answer the question immediately. If it's relevant to what I'm speaking about at that particular moment in time, then of course I'll address it. If it's not, then please bear with me. I will come to it at the end. I promise you I'll try to get through all of the questions. But we do have a good deal of content to get through today, so let me waste no more time. Let me jump over to the slides, make sure I can see anybody is asking any questions here, so I'll keep an eye on that as well. And we will get ready to get going. So, all right, so how to take big trades at win. So The first thing that we need to understand is that the Forex markets are driven in the medium to long term by economic data and sentiment-driven market themes, okay? To trade these markets successfully, to be able to take those bigger trades, we have to understand what drives them and how we can actually predict these moves before they happen, so that when we're looking at the markets, when the technical trades are setting up in front of us, it's something that we've already anticipated. So we're there and we're ready to take advantage of the moves. Now, at the very heart of it, a currency is going to appreciate in value if there's more demand for that particular currency, all right? Demand is dependent on a number of factors, which is what we're going to go through in this series here. Now, professionals, they use a combination of fundamental analysis, technical analysis, and positional analysis to derive a consistent stream of well thought out trade ideas. All right. Professional FX traders, they have a process and a framework upon which they trade their trade ideas are developed. All right. The average retail trader focuses only on the charts. All right. But if you're willing to incorporate fundamentals, and don't all sign off now, I promise you it's not as complicated as it sounds. I know a lot of you probably like, I don't care about fundamentals. I don't need to pay attention to them. I promise you, if you just follow some of the simple things I'm going to show you in this webinar right here, your trading is going to improve, tenfold. It's not going to be recognizable from what you were doing before. All right. And what this is going to do is going to allow you to increase your win rate, and it's going to allow you to take big positions when the opportunities arise, like I just showed you. But what I want to do first of all is I like to prove everything. Okay. So I'd like to take a look at an institution's currency research report and just show you some of the things that they look at, just to prove that the things that I'm going to show you here and the way that I'm going to teach you to read it is what the big institutions do. And that's how they really drive the market. So this is a report. Okay, it's actually a little while back. But what they said is, we recommend shorting the Aussie dollar as the Australia-US rates differential should move in the dollar's favor this week, with the Reserve Bank of Australia remaining on hold on Tuesday and markets progressively increasing their pricing for a 25 basis point June Fed rate hike. Okay, and again, like I said, this is a little while ago, but I picked it out because it kind of talks about the various different aspects of the trade that I'm going to teach you today. Our BNP Paribas FX positioning analysis signals that US dollar positioning is now back to net short levels, whilst the Aussie dollar is still the largest long position in the G10. Our economists expect both the ISM manufacturing and non-manufacturing surveys for March to tick up from already elevated levels. The Fed FOMC minutes on Wednesday could also shed further light on the Fed balance sheet reduction discussion, as recent comments from Fed officials suggest policy action could come sooner than expected. All right. Now, I want to highlight a few things here. The first is that we talk about rate differentials. It's something we're going to talk about today. We need to know what really drives the market. How is it that we can anticipate these moves? Because believe it or not, it's significantly more straightforward than you would imagine. They then go on to talk about FX positioning. They then talk about the ISM manufacturing and non-manufacturing surveys. These are leading indicators. For those of you that use technical indicators on your charts, they're all lagging. They're based on previous price points, previous data. Whereas what we want to do as professional traders, we want to look at that information that's going to lead the market. It's going to be able to help us anticipate where the markets are going to be in the next sort of like 3 to 6 months, because then we can build our positions accordingly. And even if you're day trading, this is going to help you. Okay, so don't switch off just because I said the next 3 to 6 months. This is going to help you in all of your trading. Then it says the Fed FOMC minutes on Wednesday. So again, they're referring to the FOMC minutes, which is after their rate announcement. All right. So the currency market drivers, what drives these markets are leading indicators. Okay, so obviously they're going to lead the market. Hard data, so it's confirmation indicators. Hard data are things like non-farm payrolls, okay, GDP, things like that. That's the hard data, inflation data as well. Then we've got central bank monetary policy, which is very reactive. We've got market positioning. Now, what's important to remember is that central banks react to the hard data. All right, they react to that second line there, whereas the leading indicators will give us a good view on where the hard data will be. So the idea is that if we can front run the central banks, we can get a bit of a head start on where they're going to be. We can position ourselves ahead of time and we can take, we can take the majority of these moves before they even start to manifest themselves on the chart. And then when they do manifest themselves on the chart and it proves to us that our theory is correct, then we can really sort of lump into the positions and take advantage of those moves. So the currency market drivers, let's break these down. The leading indicators are the manufacturing PMI and the services PMI. The hard data, the things that confirm this, is inflation, growth, and employment. And then monetary policy, central banks, what do? They look at really sort of like interest rates and expectations. And then finally, we've got the COT reports for market positioning. These, I won't be able to go through all of this today. I'm just going to go through the basics just to be able to give you a bit of an idea as to where you need to go. And obviously that's going to help you. I can't go into every single little aspect of this in the next half an hour. It's just not possible, but hopefully this should give you a good idea of what you need to be doing. So the fundamental process, the flow of data and the way that the markets react to it is it starts with the leading indicators. If we look at the leading indicators, we can understand, okay, where the markets are expected to go. What's the expectation of the economic conditions in the coming months? Once we've got the leading indicators, then we look at the hard data. The hard data will basically confirm for us whether the leading indicators are correct. And if they are correct, then we understand that our view is generally right. Then the central bank will look back at the hard data. So the central bank make their monetary policy decisions for the most part. And in fact, it was even yesterday when the ECB came out and they raised interest rates, and they pointed back to the fact that they will be looking at the data, monitoring the data to decide where they want to go with future interest rate decisions. Okay, so they look at the hard data. And then finally, you've got market positioning that will allow you to identify where are the large speculators in the market, where are the big banks, the hedge funds, where are they positioned? Because where they're positioned is going to show you where the markets are going to move overall. Okay. Now, central bank and monetary policy. Each country or economic region has their own central bank. The central bank is responsible for controlling economic activity via their monetary policy tools, okay? And in this particular, in this video here, in this tutorial, we will focus on their main tool, which is interest rates. Now, whilst there are other tools, okay, and there are other fundamental drivers and sentiment-driven drivers that will obviously move the exchange rates, in the main and over the mid to long term, so it always tends to catch up. There is a correlation between interest rates and the expectation of interest rates relative to other currencies. And that's what tends to drive the price, which is really, really important. All right. So a currency exchange rate is heavily driven by a central bank's policy. As currency traders, as FX traders, you're going to find that you will do a lot better, that you will have a much higher win rate. You'll be making more money if you're aware of what the central bank looks at in order to make these decisions. Okay, because as I said, if we can have an expectation of what the central bank is going to do, we can have an expectation and a view on the currency. So what we'll do is let's take a look at some of these, the central bank's mandates. And this is freely available. Okay, you can go to the central bank's website and you can see what their mandate is. So it's not hidden. Right, this is not rocket science. So if we look at the Federal Reserve here, it says the Federal Reserve System is a central bank of the United States. It performs 5 general functions, and those functions are conduct a nation's monetary policy to promote maximum employment, stable prices, and moderate long-term interest rates in the economy. Right, that's one of the big ones there. So employment and stable prices. Remember that. If we look at the ECB. So we look at the ECB's primary objective is to maintain price stability. Okay, let's make sure that inflation, the rate at which the prices for goods and services change over time, remains low, stable, and predictable. And I'll get into why that's important in a minute. But again, price stability. This is the Bank of England. Look at the top there. So they secure banknotes, stable prices, and a resilient financial system. The Bank of Japan. Look at the very, very top line there, the top link, price stability and the price stability target. The Bank of Japan, as a central bank of Japan, decides and implements monetary policy with the aim of maintaining price stability. Bank of Canada, it's the same thing. I won't read all of these out to you, but the Swiss National Bank, the Reserve Bank of Australia, the Reserve Bank of New Zealand, it's all the same. Okay, they all want to do the same thing, which is essentially have as healthy an economy as they can, But primary, the first thing that they need to really pay attention to is price stability, because we don't want to find ourselves in a hyperinflation type environment that you found in sort of like the late 20s, 1920s, early 30s, or even if you go to Zimbabwe and things like Zimbabwe with hyperinflation and things like that. We don't want to do that. Okay. So as you can see, a central bank's primary focus is on maintaining price stability. It's really, really important that you understand that and you know that, because it helps us try to figure out which way is it that a central bank is going to sort of like err on when it comes to their monetary policies. All right. Now, why is price stability so important for those of you that sort of don't know this information? Well, think about it like this. Okay. Price stability is the one thing that can have a dramatic impact on society. We're seeing it throughout the world at the moment with the cost of living crisis. Prices are going up. It makes life generally, okay, more difficult, because the money that you have in your bank, it isn't worth what it once was. Your electricity bills are going up. The cost of food is going up. The cost of goods is going up. It means that your salary, whatever that was beforehand, whereas last year it could buy, a certain amount of goods, now in today's world, you can probably buy 75% of that, maybe 50% of that. So then the question is, well, you don't want inflation. You don't want high prices. But then would you want prices to remain at one level? Would you want prices to decline? Well, no, we don't want that either. We want a growing economy. What you want are prices to increase at a sort of like a medium level over a long period of time. And generally speaking, it's around the 2% level. Now, why is that? Well, essentially, you want prices to rise over time, because otherwise there's going to be no motivation for people to go out there and buy goods. If they know that, why would you buy a car today? Let's say, for example, you want to go out and you want to buy a luxury car. I don't know, a Porsche. And today the price is at 90,000, but next week it's going to be at 85,000. And then in 2 weeks it's going to be at 80,000. You wouldn't buy that today, would you? Because the price is going down. And then next week you wouldn't buy it because the price is going to go down further, and so on and so forth. So you need to maintain a healthy level of inflation. You don't want deflation, but you don't want inflation that's too high. And this is a thing that the central banks tend to wrestle with on a daily, monthly basis when it comes to their meeting. Okay. So the primary mandate is price stability. That's what we want. We want a good level of inflation, okay, where there's a high demand for goods. All right. And we don't want deflation. Does that make sense? Are there any questions so far? Just type into the chat box just so I know that I can hear. Yeah, good so far. Everybody's on the same page. Okay, now it's important to understand and to identify that inflation in isolation is obviously negative for a currency because it reduces the purchasing power. Deflation in isolation is positive for currencies. It increases the purchasing power. But, and here's the important part, inflation or deflation it seldom goes unchecked. Okay. So what will happen is central banks will, their primary tool for fighting inflation and deflation is interest rates. Higher interest rates normally lead to a currency appreciation, as what happens is, remember the supply and demand argument. So investors will flock to a particular currency where they've got higher interest rates because they'll get a higher return just for holding that. All right. So what traders tend to do is that they go to the places where there are higher interest rates and they steer away from the places that have got lower interest rates. It's something called the carry trade that we will talk about later. But that is the reason that you've seen last year that you saw, the euro dollar sell off, pound dollar sell off, dollar yen appreciates. And then towards the end of the year, November, December, January time, it's the reason that you saw the US dollar sell off. So you saw the euro dollar rally. Knowing that information, you would have been in a situation where you could have taken advantage of those moves because you knew what was behind it. You wouldn't have had to sit there for extra confirmation from the market, extra technical confirmation. You would have known exactly what to do and you could have got involved there and you could have made money from your positions. Okay. So this is just to kind of show you, all right, inflation and interest rates, just to show you the correlation there. So you can see, right, the inflation is the green line. So as inflation starts to rise, interest rates are rising as well. Interest rates start to drop when we start to see that inflation is going to come down. Now, it's not always week by week lockstep, but you can see that there's a correlation here. So if we can take a view on where inflation is going to be, then you kind of have an idea on where interest rates are going to go. And if you have an idea on where interest rates are going to go, then you will have an idea on where the currency rate, the exchange rate, is going to go. All right? So central banks, they control inflation and deflation by adjusting interest rates. If an economy is overheating and prices are rising, we've got inflation like we do today, you've seen that central banks are raising interest rates, right? You've all seen that over the past year or so. Higher interest rates. So why would they do that? To stop an economy overheating? Well, higher interest rates makes it more expensive to get a loan, okay, and fund business. It's an incentive to save, so you don't go out there and you don't spend all of your money. It curbs spending, and it's positive for a currency. If an economy is slowing down and prices are falling, then the central bank will cut interest rates to try and stimulate and encourage economic activity. So there's less incentive to keep your money in the bank because you don't get anything for it. It encourages spending, and it's also negative for a currency. Okay? So the key things here are higher interest rates. An expectation of higher interest rates is good for a currency, and lower interest rates and the expectation is really important here, is bad for a currency, because it's not just what is the interest rate differential between two economies, what it is right now. It's where is it going to be? You know, much of the euro dollar rally, for example, towards the end of last year and beginning of this year, it wasn't because that, the euro, so the ECB, had higher interest rates than the US or the US and the US dollar. What it was that there was the expectation that the Federal Reserve were going to start to cut interest rates, and the ECB hadn't finished with their rate hike cycle. So there would be a difference there, but there wasn't at the time. It was the expectation of that. Now, the other thing that we need to keep an eye on is employment, because the central banks are going to keep an eye on that as well when they're making their monetary policy decisions. The biggest example of that is in the last month. So if you remember back to February, we had the non-farm payrolls come out, and it was very, very positive. Unemployment was down. It's like 3.4%. And I think we added over 500,000 jobs to the economy in February, well, January, and in February's number. And what did we see? We saw the dollar appreciate over the month of February. Okay? That was a position that I was in. I made a lot of money trading the dollar yen during that time, just on that basis. And you will be able to do that too. Okay? So I'll jump on a little bit here because I know that we're already halfway into this. So we all understand about interest rates, yeah? Or do you want me to stick there? But just essentially what I want you to see here is that interest rates and interest rates differentials, okay, are closely correlated to exchange rates. If you look at this particular graph here, you'll see the dollar index is the blue line and the interest rate differential is the orange line. And look at the way that the dollar index follows the interest rate differential. And it's like a weighted one between UK, Japan, and Germany, and Europe. But look at that there. Look at that differential. Look at the dollar index. So can you all see how, if you're able to take a view on where interest rates are going to go, you're going to be able to take a view on the exchange rates? Please type yes or no into the chat box. Can you see that? Can you see the benefit of doing this? Yeah? Excellent. So the Federal Reserve, they react. Okay, they react to the hard data. That's how they make their interest rate differentials. In fact, the Federal Reserve, okay, have reacted after the event when it comes to recession. So stats show that 6 out of the last 9 recessions, the Fed have only cut rates after the first recession has actually started. Right? That shows you that they react to the hard data. So if we look at our leading indicators to give us a view on where the economy is going to go, where the hard data is going to be, then we know what the Federal Reserve are going to do. We know what the central banks are going to do. If we know what they're going to do with their monetary policy decisions and their interest rates, the way they manage their interest rates, then we know where the exchange rate is going to be. Look at this here, right? So you can, the red lines show the recessions, and then you can see the Fed fund rate after that. It only tends to start dropping after the event. 6 out of the last 9. They're getting better at it, starting to cut a little bit before now, but really it's after the event. All right, so central banks are use interest rates to control economic activity with a focus on inflation, growth, and employment. So why is it? Let's talk about the why, right? Because this is really, really important. I don't want to just kind of, give you all of this theory and not show you why this actually happens. Well, there's something called the carry trade. Have you all heard about the carry trade before? If not, no problem. I'm going to go into it now. But essentially, the carry trade is an investment strategy where you will sell a currency that has a low interest rate and you will buy a currency that has a higher interest rate and you will collect the interest rate differential. Right? So for example, when I was buying the dollar yen throughout February and the beginning of March, I made maybe 15% of my overall profits from that particular position from the swap that I got from my broker. Imagine that. I made an additional 15% from that. Now, on the surface, it seems like it's a low yielding strategy. But when you apply leverage and a global view, you can actually be extremely profitable. And this is what I want to show you here. This is the point of this tutorial, this presentation we're doing here, is to show you how once you can derive a view on where the central banks are going to head with their interest rates, then actually they tell you all you have to do is read their meeting minutes and things like that, and they'll tell you exactly where they're headed. All right. And once you can do that, then you can get a view on the currency. And this right here is how you will make your money. It's not to say that you get involved in the carry trade, but you have a view on where the carry trade is, and then you trade in that particular direction. All right. So like I said, on the surface, it seems like a low yielding strategy, but when you apply leverage, okay, you can make a lot of money. All right. Not just if your view is correct. Obviously, that's part of it. And that's where you guys and girls will probably make the majority of your money, is that you'll have a view. So you'll make money on the position itself. But what will be pushing that position are what the large institutions are doing, which is they are basically taking highly leveraged positions in the direction and the expectation of positive carry. So the positive interest rate differential, and then it becomes a self-fulfilling prophecy. So what happens is a low interest rate allows investors to borrow money in a country that you pay very little interest in. Then they can take that money and invest it in a place, even in like government bonds, for example, and they can get a higher yield there. Now, it seems low yield to start with because, you're not going to get 15, 20, whatever percent. But if you can leverage that position and it's free, if you're borrowing money in Japan, for example, where it's basically, zero interest rates, you're not really paying anything on that. And then you take that to somewhere like the US, where we're 450 at the moment, 4.5%. And next week, it'll probably go up to 475 to 500. You're making a 5% return for doing nothing. You leverage that 10 times, 10 to 1 leverage, you'll be making 50% a year for holding a position. And then knowing that the rest of the market is with you, okay? Knowing that the rest of the market is going to push that position in the direction that you're already holding. So you make money on the interest, on the swap that you're making, and you make money on the FX position. Okay? Now, like I said, as we trade currencies in pairs, the rate differential between the two currencies is more important than the individual rate. So it doesn't matter if, let's say, for example, one interest rate is 3% and the other is 1%. Okay? It's the 2% in between that's important. All right? So, for example, we could get a currency with a differential of 2%. And one country's interest rate could be 7%, the other could be 5%, but the net result is the same as if it was 3 and 1%. Okay? So this is what we're looking for. Now, if we take a look at a carry trade, so if you look at the Aussie dollar over the last year, you can see from this chart that the exchange rate follows the interest rate differential. So as the interest rate differential between the two narrowed, you can see that the exchange rate came down. Right? The rate differential is the blue line. The Aussie dollar exchange rate is the orange line. That's not perfectly lockstep, like I said, but it does tend to follow it. So if you have a view on this, you have a view on where the markets are going to go. So let's have a walkthrough of the carry trade, just so you know what it is that we're talking about. And we'll take an example of the Aussie dollar. And these are hypothetical numbers, all right? But I just want to show you how it is that they make money. So if a trader were to borrow $1,000 from a US bank and convert the funds into Australian dollars and buys a bond for the equivalent amount, what does this mean? Well, let's assume that the bond pays 4.5% and the US Fed fund rate is 0.25%. It's not, okay? I know it's not at the moment, and the US is actually in a more positive situation. They've got higher interest rates. But generally, so let's just imagine this for a second. The trader would stand to make 4.25% as long as the exchange rate between the countries doesn't change. Now, what happens is many traders use this trade, okay, because the gains become very large when you apply leverage. So 4.25% on its own. We give it 10 to 1 leverage, and then the trader, she can stand to make 42.5% profit. The risk to this is a volatility in the market, so risk-off environment. So one of the things that you need to think about is that if you're embarking upon something where you're taking advantage of the carry trade, the thing that can go against you is that when investors do this, right, it's known as sort of like a high risk strategy. So when risk comes into the market, for example, what's happened with Silicon Valley Bank this week, you will start to see a bit of an unwinding as to that carry trade. You can actually see that in the dollar yen at the moment. The dollar yen is selling off as a bit of a risk-off type dynamic. Some of it seems counterintuitive. You'll look at some currency pairs and you'll be like, it doesn't make any sense that they would be fleeing from one particular economy to the other. This economy is stronger. But if there's general risk in the market, all it is something called the unwinding of the carry trade. Okay? Now, the big risk to the carry trade is the uncertainty in exchange rates, but you guys won't have to worry about that because I'm not teaching you to take the carry trade. I'm just teaching you to read the carry trade, to read where the markets are going in terms of interest rate differentials, and then to structure your portfolio and your trading accordingly. Okay, so let me jump across to some charts just before we wrap everything up here, just to show you what I'm talking about here. 1 second. Can you all see the charts in front of you? Yeah? So when we're talking about the carry trade and people sort of going towards places where they're going to get bigger bang for their buck, all of this movement, let me move out to a daily chart here, in fact. So all of this move, right, in 2021, 22, so all of the last year here in the US dollar. So we can see that the euro is the base currency, the dollar is the quote currency. So if the price is coming down, it means the US dollar is strengthening. Why would this be? Well, throughout last year, the Federal Reserve was really ahead of the curve in terms of increasing their interest rates and the expectation of how aggressively they were going to do that. So you could see here that if you have that expectation, and the way that you do it, by the way, is obviously you read their policy meeting notes. Okay, they'll actually tell you, and then you pay attention to a few key things. So you pay attention to the ISMs. Okay, so the PMI reports, they will tell you whether they're expecting the economy to expand or contract. You pay attention to inflation numbers, CPI, etc., and you pay attention to employment. And if you get a view on all of those and you get a view on where the central bank will be, plus they're telling you anyway, okay? And as you can see here, you could have taken a position. You could have said to yourself, Because my expectation is that the Federal Reserve are ahead of the curve, I want to be a seller of the euro dollar. I want to buy dollars against the euro because I know the ECB are going to be behind. So you take off the opportunity on the table here for you to actually buy the market. So all of these breaks to the upside, you don't consider them because it's not in line with your fundamental view. You wait. Okay. And then you take the opportunities to sell the market. And as you can see, when you look for opportunities to sell the market, it's really very difficult to lose money. Now, what happens over here? Well, here we got a little bit of a change. So the Federal Reserve was starting to slow down with their interest rate hikes. They're going to more neutral monetary policy or their stance. But the ECB hadn't finished. So the expectation is that the ECB would be hiking rates and the Federal Reserve would start to cut rates, which then gave the opportunity for the euro bull to say, well, actually, now we're going to have a differential on the other side and the market will start to move up, which it does. And that brings us to where we are right now. Similar sort of thing for the dollar yen. Okay. All of this last year, the markets knew. They knew the Bank of Japan were going to do nothing. And they knew the Federal Reserve were going to hike interest rates. This was the easiest trade you've ever seen in your life. Seriously. The ones to do with the Bank of Japan in general are really, really straightforward because the Bank of Japan typically, they aren't as aggressive as other central banks. Now, what will happen is if the Federal Reserve start to cut their interest rates, you will start to see a move to the downside. Next week's meeting is going to be very telling. It's going to give us a lot of information. And with that, you can build a view on the fundamental picture. And with that view, you can then trade accordingly. And you can take trades that are larger. So you'll say, well, I'm not going to take 1% risk because I've got the fundamentals with me. So in fact, I'm going to take 2% risk. Or you could build into positions. You can say, well, I'm not going to take profit here because I think the market's going to continue going. And what I'll do instead is that I will look for opportunities to add to my position. So instead of this being a 1-to-1 risk to reward ratio where you might make 1 or 2%, you've added to your position several times during this up move and you walk away having made 10, 15, 20% from it. And that is how professional traders trade. We don't sit there and try and get involved when we don't really have a view on what's going on. You can take trades technically. Absolutely you can. You just take them with smaller position sizes. So if I don't have a fundamental view of my trade, I'm going with 0.5% of my account. The moment that I've got a fundamental view, the position, the risk that I'm taking with my account is significantly more. I did over 30% return last month, trading just this trade here, just this upwards move here in the dollar yen. This little movement here. Ordinarily, for most of you probably looked at that technically and thought, oh, can't take that. Maybe if I jump down to a 4-hour chart, there are a few opportunities here. Maybe you were lucky enough to make 3-4% from that. Over 30% from this position. So we are now coming towards the end of this presentation here. I think I've got a few minutes left. So what I want to do is I want to open up the floor for any questions that you may have before we need to wrap up this webinar here and let you get on with your wonderful days. So do you all have any questions at all? Can you see how this can be helpful for your trading? What risk, Heidi? It was a series of different trades. So none of the trades I took were more than 2% risk of my account. Okay, typically speaking, like I said, I'm usually at sort of like 0.25% if it's just a technical one. But there were a bunch of positions involved here. So there were a good sort of 5 or 6 positions I built into as the market was moving with me. Exactly, James. It takes all of the guesswork out of technical analysis. The way that I trade, the way that I teach my clients to trade is to say that by the time you get to the charts, right? By the time you're looking at the technical chart, you've already got a view on what you're going to do. You already have a view there. So then the challenge is just, well, where do I enter? I know which direction I want to be in. So where do I enter? It makes things a lot more straightforward. And once you're in the trade, you've got more confidence. If the market goes against you, you don't mind because you know that you're in line with the fundamental view. So you get the technicals aligned with the fundamentals. You get the fundamentals drive you to the place where there's going to be the biggest opportunity. Okay? At the moment, the landscape is a little bit murky because a lot of the central banks, they're still raising rates, but they're now starting to look at data. You know, Bank of Canada have actually paused. RBA have sort of opened the door to the fact that they may pause next. So the next move is going to be who's going to cut first. So what you need to do as a trader is you need to wait until that picture is clear. Trade technically, trade tactically, so small positions here and there. But then when the view becomes clear, then you get involved. And that's where you do your, 100% in a year and things like that. Which, by the way, is another thing that maybe I'll do a webinar on next time, is that where I think that people's attitude to risk and people's expectation is kind of, it's all wrong. So you either get people that think they can do 100% a month, which is ridiculous, or you get people saying, well, actually, the big banks of funds, they do 20% a year, so that's what I'm shooting for. Yes, they do 20% a year, but their mandate, okay, their offering documents will look very, very different to what you'll be doing. So they'll have to have predefined levels of risk. They won't be able to get into the markets as quickly as you. So from your perspective, as a retail trader, there is no reason you shouldn't be generating 50 to 100% per year returns on your capital, unless you're super conservative, which is fine too. But if you're sort of like have a moderate risk profile, that should be the sort of thing that you're looking for. Really interesting. You missed the first 20 minutes of this event. Yes, it will be recorded. I'll be doing another one soon. It won't necessarily be on this subject. So, but yeah. Yes, it was in the direction of positive carry, Heidi. That's a consideration. What timeframes do I favor? Generally, Hub, I like the daily timeframes and sometimes a 4-hour if I can't get a good enough read from the daily perspective, because the daily is quite difficult. It's slower to turn around and things like that. Okay. Which broker do I use? I use Pepperstone. I find that they're more competitive with their spreads and things like that. So. Okay, everybody, we have come to the end of our 45-minute. Does Pepstone have lower leverage? I don't think it's the highest leverage out there, but you don't want to be super high leverage, Namdi. Okay. Yeah, we've come to the end of our 45-minute allotment of time. So I hope you all enjoyed this. I hope that you've got value out of it, something that you feel that you can take into your own trading and you can see how you can build into positions here. What I will do is if you have any questions, yeah, was it right? Did I get the right pronunciation? If you have any questions, please feel free to send me an email. I'll put my email in here. Okay, you can also go across to my website and you can sign up for one of my masterclasses where I go through this kind of information, sometimes in a little bit more detail. You can also join me for some live trading sessions. So there's my email address in there. Obviously, tradethemarket.co.uk, the domain, that's my website. So if you want to sign up for the masterclass, you might enjoy that. But yes, pronounced it well. Go on. But yeah, like I said, here to help. I want you all to be successful. If you have any questions, just pop me across an email. Hopefully you can all see the email I posted in the chat box. As I said, jump across to the website if you want more information, join the live trading sessions. Otherwise, I'll wish you all a very, very nice weekend. Thank you so much for joining. Thank you very much, FX Street, for putting on these things. They are the best. I've been working with FX Street for probably over a decade now. And there's literally no one else out there like them in the market. So thank you very much. And I will see you all soon. Have a really good weekend. Take care. Happy trading. And I wish you all of the profits in the world. Bye-bye now.